Did you know climate change isn't just an environmental issue anymore? It's a financial one. From rising insurance premiums to stranded coal plants, climate risks are reshaping the way global markets work. In today's video, we will break down what climate risk means, the different types of risks, and real world case studies showing how businesses and investors are being affected. Welcome back to Biz Case Studio, where we simplify MBA concepts through real case studies and practical examples. Welcome to the Sustainable Investing channel, where we explore how finance and sustainability come together. If you are new here, don't forget to subscribe for more case studies and insights. Today's topic is climate risk and financial markets. Before we begin, a quick note. If you'd like detailed student friendly notes for this video of our previous videos in the playlist, you can grab them for just $1. The link is in the description. Go check it out and do help us. What is climate risk? Climate risk refers to the potential financial impact of climate change on companies, assets, and entire economies. This could mean rising costs, lower profits, or even the collapse of industries that fail to adapt. Today, climate risk is no longer seen as just an ethical issue, it's a material financial risk. That's why regulators around the world, like the SEC in the US, the EU, and the Task Force on Climate Related Financial Disclosures, or TCFD, now require companies to disclose their climate related risk. Let's break it down into three main categories. The first one, physical risk. These are the direct damages from extreme weather events like floods, hurricanes, or wildfires. For example, the Hurricane Katrina in 2005 caused damages worth over $125 billion, hitting insurers and local businesses hard. Second, the transition risk. These come from the shift towards a low carbon economy. Governments may impose carbon taxes on new technologies, may make fossil fuels uncompetitive. For instance, many coal plants are now considered stranded assets because renewables are cheaper and policies are against coal. Third one is the liability risks. These involve lawsuits or legal challenges against companies for their role in contributing to climate change or misleading investors. For example, oil majors have faced lawsuits for greenwashing, making sustainability claims that don't match their real practices. Let's see each category in detail. Physical risks are the most visible ones. They include damages caused by extreme weather, such as hurricanes, floods, and wildfires. For example, we have seen Hurricane Katrina in 2005, which caused $125 billion in damages. Insurance companies, businesses, and local economies also suffered massive losses. Today, we are seeing more frequent wildfires in California and floods in Asia and Europe, which are forcing insurers to raise premiums or to even stop covering high risk areas. This shows how climate change directly translates into financial costs. Transition risks happen when policies, technologies, or market trends shift towards a low carbon economy. For example, we have seen the coal fired power plants that were once profitable are now standard because renewable energy is cheaper. A good example is the UK's rapid decline in coal usage. Within a decade, coal went from powering 40% of the grid to almost zero, leaving coal companies with worthless assets. Investors who didn't adapt, they lost billions in value. And the third one we saw was the liability risks, which involves companies being held legally responsible for their role in climate change. Now, let's take an example. Oil majors like Exxon Mobil and Shell have faced lawsuits from cities and states in the US, accusing them of misleading the public about climate change. Similarly, some companies have been fined for greenwashing, making false or exaggerated claims about being sustainable. These legal battles not only create direct financial costs but also damage the investor's trust. Let's take a case study of the insurance industry, which will explain more of this topic. Insurance companies are on the front lines of climate risk. Every wildfire, flood, or storms lead to billions in payouts. As a result, some insurers are even exiting high risk markets like wildfire prone parts of California. This directly shows how climate risk impacts financial stability. A second case study is regarding the energy and asset managers. In the energy sector, we have seen coal companies lose massive market values as renewable take over. On the investment side, BlackRock, one of the largest asset managers, has declared climate risk as a defining factor for investment decisions. This shift shows how even traditional finance giants are adapting to climate realities. So it's no more a discussion, it's more of a financial crisis, the climate change. So, what can MBA students and professionals take away from this? Let's see. Climate risk now affects valuation models and portfolio strategies. The concept of stranded assets is real, meaning billions can be lost if industries don't adapt. Climate disclosures like TCFDs are becoming as important as financial statements. Companies that adapt early by investing in renewables or green technologies will gain long term competitive advantage. Now, these are some significant points to be remembered when investing sustainability. Now it's your turn. Think about this. What do you think is the biggest climate risk for financial markets today? Is it physical risk like storms and floods, transition risks like stranded fossil fuel assets, or liability risks like against companies? Let us know in the comments below. We would love to hear your thoughts, and let's do a brainstorming together. We'll talk, we'll chat, we will discuss all together. And just remember, no answers are wrong. It's all a discussion. In short, climate risk is not just about tomorrow. It's already reshaping financial markets today. Whether you are an investor, a student, a business leader, understanding climate risk now is a must. If you found this video useful, don't forget to hit like. Please share it with as many as possible people, and subscribe. Please subscribe for more and more case studies on in sustainable investing. And we do have other playlists like organizational behavior and some more playlists coming up. So please subscribe, like, and don't forget to share. Check out our full playlist, Sustainable Investing, and you can look at the other videos which we have uploaded earlier for more and more detailed concepts on sustainable investing. Thank you. Have a safe day.